Good morning, everyone. Hope you all must be doing great. Guys, it was our taxation paper on 17th of September, and I received the feedback of many of the students. I read the paper also, and I found yes, the paper was a bit difficult. It was difficult. It was very, very conceptual. But at the same time, the point which is pinching me is that it was very, very lengthy. I see that there were some questions which were just for 4 marks. And institute is asking so much from the students. There were so many concepts which are being tested in that small question of 4 marks. So it was making the paper very, very lengthy. See, in always in examination, in every attempt, there is one paper which is a bit difficult. Unfortunately, this time it was income tax. Still, I would say, guys, don't worry, because if you see the history of these examinations, then you will find that whenever there is a difficult paper, the marking is lenient. So be positive. If you have done pretty well in your examination, then don't worry, be positive, you will be able to clear the paper. However, if there is any student who feels that no, I'll not be able to clear the paper, then don't worry, guys. Please start studying from right now. I'll be posting some more helpful videos for you. Even if you want, you can drop me a WhatsApp message at my number. I'll call you back in case you would like to discuss. Then definitely I'll call you back to discuss anything. Right. So now let me discuss this paper. Each and every question we will be discussing it so that you can now match your answers with my answers. And in case if there is any student who is watching this and their group 2 examinations are on, then I would suggest that please skip this video for now. You can watch this after your group 2 examinations. And for students who are already done with your group 1 and they are not going to appear for group 2 right now, they can continue with me, right? Okay. So I'll be discussing the income tax portion, guys. I'll not be discussing the GST portion. So come to case scenario number 2. So first, before reading this case study, let me read the questions first. So it says net annual value of the house property for assessment year 24-25 is. So here we have to calculate the NAV of the property. Okay, there would be this would be a house property question. Deduction in respect of interest on loan for previous year 23-24. So they are asking about section 24B. What would be the interest on loan which is deductible under section 24B regarding house property? And the 8th question is compute her total income for the assessment year 24-25. So we have to calculate the total income also. Okay. So there are 3 things. We have to calculate the NAV. Second thing, we have to calculate the interest on loan, that is 24B deduction. We have to calculate the total income of the assessee as well. Okay. Let's read out the case study now. It says, Miss Prerna is having a residential house property in Nagpur. Okay. Of which 1/3 is self-occupied. 2/3 is let out for commercial purpose at a monthly rent of 12,000 per month. Okay, so 1/3 portion is self-occupied, 2/3 is let out. Fair rental for the let out portion was 30,000 per month. So they have given the information for the expected rent also. Fair rent, this is for the entire house. No, it is only for the let out portion, that is 2/3 portion. It is 30,000 per month. Okay. Municipal value for the property is 240. Is it also for the let out portion? No. They are saying municipal value of the property. It means that this is for the entire house. So for let out portion, it would be 2/3. And standard rent under Rent Control Act was 3 lakh for the entire property. Okay. So they have given all the 3 information. Fair rent they have given, municipal valuation they have given. They have also given the standard rent. We can easily calculate the expected rent of the let out property. Okay. Municipal taxes are 10% of the municipal value and are paid by her on 30th July 2023. So she had paid the municipal taxes also during the year. So if you have already paid the taxes during the year, then we can allow it. If they are not paid during the year, then we are not going to allow it. So it will be allowed because she has paid the municipal taxes. She took a loan of 45 lakh for the construction of this house from a scheduled bank on 1/4/2021. Okay. She repaid the entire loan along with interest on 30th of June 2023. See, our previous year is 23-24. So in our year, in the previous year itself, she has repaid the entire loan along with interest. So whether the loan was outstanding for the entire year, no. In this year, it was repaid also. So and it was repaid on 30th of June 2023. So this means that in this year, whenever we will be calculating the interest for this year, it will be April, May, and June. That is for 3 months, correct? The interest rate for this loan was 10% per annum. The construction was completed on 30th June 2022. The loan was taken on 1/4/21. Construction was completed on 30th June 2022. That is, there would be the concept of pre-construction interest also. Okay. She earns other income of rupees 2 lakh during the previous year 23-24, and she wishes to opt for default tax regime. Okay, now she is opting for default tax regime. And what does default tax regime says regarding house property? It says that if there is a self-occupied portion, or if there is a self-occupied property, we are not going to give any deduction related to interest for self-occupied property in case the assessee is following default tax regime. So in our case, the assessee is following default tax regime. So for self-occupied property, we are not going to give them any deduction related to interest. For let out portion, we can give. Okay, so this is the question. Now we have to calculate the NAV, then we have to calculate the interest amount, and then we have to calculate the total income. So in case anyways we have to calculate the total income, so I'll be calculating the entire house property, and then whatever the income which we will get from house property, we will add this income also of 2 lakh. This is other income, so we can get the total income also. And while calculating the house property, we will be getting these two information as well. Okay, so we have, let me do it over here. So we have 1/3 portion which is self-occupied, and we have 2/3 portion which is let out portion, right? And how we calculate our house property income? First, we have to calculate GAV. Then we have to deduct municipal taxes which are paid by the assessee. After that, we will get the NAV. And from NAV, we will deduct 24A, standard deduction of 30%. And we have to deduct 24B, that is interest, so that we can get our house property income. This way we'll be able to get our house property income, right? So what would be the GAV for self-occupied property? We understand we start with NAV for self-occupied. We don't calculate GAV or municipal taxes. For self-occupied, it is nil. 24A, obviously it would be nil. And 24B, although there is an interest, see 45 lakh, there was a loan and there was some interest also 10% per annum. But we understand that we are following default tax regime, so there would be no deduction of interest, right? So for interest, there would be no deduction. And for self-occupied, the income would be nil. House property income would be nil. Okay. Now we are left with let out property. First of all, we have to calculate the GAV. Okay. How we will be computing the GAV? Let me calculate the GAV over here for let out portion. Tell me what is the expected rent. So we have to calculate the fair rental value and municipal value, whichever is higher, and then we have to compare it with the standard rent, whichever is lower, that would be the expected rent. Okay, so first we have to calculate the expected rent. Tell me what is the fair rental value of the property, only of the let out portion, that is only of the 2/3 portion. So we have, it is given that only for the let out portion, we have 30,000 per month. So 30,000 into 12, it makes 3.6 lakh. 3.6 lakh is the fair rental value. And how much is the municipal value? It was for the entire property, right? 240 is for the entire property. So I can say that 2.4 lakh into 2/3, it will be 1.6 lakh, whichever is higher. We have to take whichever is higher. So 3.6 lakh would be higher. And this amount, we have to compare it with standard rent. And how much is the standard rent, guys? I believe it was 3 lakh. Yeah, it was 3 lakh for the entire property. And we are concerned with 2/3. So 3 lakh into 2/3, it would be 2 lakh. So whichever is lower. So our expected rent comes out to be 2 lakh rupees, right? 2 lakh is our expected rent. Now tell me, to calculate GAV, we have to compare expected rent with our actual rent. So actual rent was how much? It was 12,000. I believe it was 12,000 per month, right? Let me check it out. Actual rent was how much? Yeah, 12,000. There was no vacancy, nothing was there. So we are believing that for the entire 12 years, it was let out. So 12,000 into 12, it makes 1.44 lakh, 1,44,000. So we understand that expected rent is higher, expected rent, and we have compared the actual rent, expected rent is higher. So GAV would be 2 lakh rupees. Okay, guys, GAV would be 2 lakh. And how much is the municipal taxes? Municipal taxes were 10%, and she has paid also 10% of the municipal value. Should I take municipal value as 2,40,000, 10% of that? No, it was for the entire property. So we have to only take, we are calculating just for the let out portion. So municipal value was 1.6 lakh for the let out portion, 2/3. So it would be 10%, 16,000 rupees. So deduct 16,000, you will get 1,84,000. 30% of this amount, 184 into 30%, 55,200. 55,200 would be 24A deduction, and 24B is interest. We have to calculate the interest, guys. Now this is again 45 lakh was the outstanding amount, and there was pre-construction period also, because the loan was taken on 1/4/2021 and it was completed on 30th June 2022. Okay, so first of all we have to calculate the interest. So let us first calculate the pre-construction period interest. Pre-construction period, guys, first of all we are calculating the period interest for the entire house, then we will be doing the 2/3. Okay, so the pre-construction period will start from 1st of June 2021, right? And it will go till 30th of June 2022. No, it will go till 31st March 2022. You all understand this, right? So from 1st April 21 to 31st March 2022 would be the pre-construction period. I believe it's just for 1 year. So this is pre-construction period is 1/4/2021 till 31st March 22. So this is just 1 year, and the amount was 4,50,000. No, it was 45 lakh. The outstanding amount was 45 lakh into 10%. It was 4,50,000. Right, this pre-construction period. And we can take the deduction in 5 equal installments starting from previous year 22-23 is the first year. Our previous year 23-24 is the second year. So we are coming in those 5 years. So we can take the deduction of pre-construction period interest also. So how much would be the pre-construction period interest? 4.5 lakh divided by 5 in 5 equal installment. So I'll be dividing it by 5. So I can say every year we will be taking 90,000 as the pre-construction period interest. But mind, guys, that this is for the entire house. We have to do 2/3 out of it. So let me calculate the interest also for this particular period. Then we will club it together and then we will do 2/3 out of it. Okay. And what is the interest for previous year 23-24? See, the outstanding was 45 lakh and we repaid this. The entire amount has been paid by the assessee on 30th of June 2023. That means in this year we have used the loan for 3 months, April, May, June. So let us calculate the interest for on 45 lakh, 10% for 3 months, 3/12. How much it is? 4,50,000 divided by 12 into 3. Guys, it is 1,12,500. So this is the interest for this particular period. So we have this interest, this interest. Let me sum it up. I'm running short of space over here, so I'm writing it somewhere else. This and this amount, right? So this and this amount would be 2,02,500 would be the interest. But guys, this is for the entire house and we have to do 2/3 of it. 135 is the interest. So 1,35,000, sorry. Give me a minute. Okay. 1,35,000 would be the interest. So how much is the house property income? 35,200 minus 184. 6,200 negative, right? It's a loss. House property, we have a loss. Okay. So we have got some of the answers. First of all, they were saying to calculate the net annual value. So the net annual value for the house property for self-occupied, it is nil, and for this it is 1,84,000. So we have this answer. 184. C is the correct answer over here. Seventh, they were asking about the interest. So what would be the interest under section 24B? See, in let out portion, we will not, sorry, in self-occupied, why I'm saying let out? In self-occupied portion, we will not get any deduction. Why? Because we are following default tax regime. So here we will not get any deduction, but here we will be getting 135. So the total amount which is there under section 24B for the assessee is 135. So 135 would be the answer. And the seventh, okay, the eighth question was asking about the total income of the assessee. Okay, so we have a loss under the head house property 6,200, and there is some other income also. How much it was? 2 lakh rupees. So 2 lakh was the other income. Guys, please remember the assessee is following default tax regime. Now we understand that the other income is 2 lakh and there is a house property loss. See, here the assessee is following default tax regime. Please remember the chapter of set off. If the assessee is following default regime, they cannot set their house property loss from any other head. It has to be carried forward. So this 6,200 rupees loss cannot be set off from this 2 lakh rupees income. So my income for this particular year would be 2 lakh only, right? So it would be 2 lakh, guys. 2 lakh would be the income. See, this answer is also given that they have deducted 6,200. No, but this is not the correct answer. The correct answer is 2 lakh over here. Got it? So I believe that you are able to understand this particular case study. Okay. Let me come to case scenario number 3. Mr. Desai, age 52 years. Let me read the questions first. So we have question number 9 to 11 over here. What shall be the total income of Desai for assessment year 24-25? So we have to calculate the total income of the assessee. Okay, we'll calculate. Which of the following statement is correct in respect of deductions available to him under chapter 6A? So this seems to be a theoretical question, so that we will do, no problem. What is the requirement of deduction of tax at source by game.com in respect of such winning by Mr. Desai? So they were asking something about TDS. So we got it. First, we have to calculate the total income. There is some theoretical question related to deduction. And then we have to calculate we have to determine the amount of TDS also, which is deducted by some game.com. Okay. Now let us read the case scenario. Mr. Desai, age 52 years, is an Indian resident. He gives the following information to you relating to the previous year 23-24. Okay, profit from business carried out in Dubai, controlled from Dubai, 13,10,000, received in a bank account in Dubai. Okay, business is in Dubai, not controlled from here, controlled from Dubai, and also received in Dubai. Whether this amount would be taxable here or not. Who was he? Mr. Desai is 52 years, is an Indian resident. Okay, so they have mentioned that this person is a resident. Now they have not mentioned that whether this person is an ordinary resident or a not ordinary resident. See, I always tell you that whenever the question is silent, I always used to tell you that whenever the question is silent about the age, we always take normal age, that is up to 59 years. If the question is silent about the residential status, we always consider that person as a resident, and that too ordinary resident. So if nothing is mentioned, although they have mentioned that the assessee is resident, but however, whether the person is ordinary or not ordinary, so whenever the question is silent, we always assume that the person is an ordinary resident, right? So we have to give our answers as per the ordinary resident. So if we understand for ordinary resident, the entire global income is taxable. So even if this is a PGBP income, which is arising in Dubai, received in Dubai, not even controlled from India, still this will be taxable. Why? Because this person is a ordinary resident. We will assume, they have not mentioned, but we will assume that this person is an ordinary resident. We cannot assume that this person is a not ordinary resident. If if you see, if you will be taking that, it would be, this person could be a not ordinary resident also. See, in this case, question always mentions such things. Otherwise, we always take that this person is a ordinary resident. Okay. So 13 lakh 10,000 would be the PGBP income taxable in India. Global income would be taxable. Loss from a business in Delhi 450. Okay. This is the loss, PGBP loss. So this PGBP loss can be set off from this particular PGBP income. We can set it off. During the financial year 23-24, he also played some online games. Okay, they are asking about section 194BA, right? TDS. They were asking about the online gaming TDS also, right? So during the financial year 23-24, he also played some online games on a particular Indian website, game.com. Online games. Game.com is a manufacturer of men's shirt. During the year, Desai won 6 shirts, such shirts. So what he won is the shirt. It is not cash, but it is in kind. Doesn't matter whether you are winning any cash amount or you are winning any kind amount, that is also taxable. You have to pay tax at a rate of 30%, and also TDS is applicable at a rate of 30% here. Okay. The cost of manufacture shirt by game.com is 3,000 per piece, and it sells these shirts at 10,000 per piece, excluding GST at a rate of 18%. However, to play such games, Desai had to deposit a sum of 50,000 rupees with the website as a refundable deposit. It's a refundable deposit. Okay. Okay. Now we understand that whatever we have won from there, we have to take the value of that. So the manufacturing cost was 3,000 per piece, but that is not relevant for us. What the winner is getting a shirt which is actually, the market price was how much? 10,000 rupees. So we have to take this 10,000 value, right? And excluding GST, it's perfectly fine. We don't have to include GST over here, just the value of the shirt. So 10,000 per shirt would be our winning portion. And there were 6 such shirts. So 60,000 is the gross winning, right? And can we deduct the amount which we have deposited? Can we deduct that while computing the net winning figure? The answer is no. Why? Because this amount is refundable deposit. If they would have mentioned that this is non-refundable, then I would have deducted 50,000 also from here. But this is a refundable amount. You will get it back. So what you want, what is the extra amount which you want, is 6 shirt of 10,000 each shirt. So that is 60,000 rupees. So here your income would be 60,000. So I can say here in first portion, the income was 13.1 lakh. There was a loss of 4.5, which we can set it off from this particular PGBP, and 60,000 is this person's IFOS income, but yes, online gaming. And TDS will be also, because there was one question regarding TDS. So game.com is required to deduct TDS. So we have section 194BA also. Although you don't have to mention the section, it was just an MCQ. So there is a section 194BA. It says that game.com is required to deduct 30% tax on 60,000. So it would be 18,000 rupees. Okay. Fourth, on 23rd May 2023, during our previous year, he gifted listed equity shares in an Indian company to his son's daughter. It's not son's wife, it's son's daughter. See, if this person would have given it to son's wife, then there would be the clubbing provisions. But now this person is gifting it to son's daughter, right? To her, and I can say to her, to his granddaughter, he is gifting this shares. To Miss Shania, okay, she is the granddaughter. These shares were purchased by him on 1/4/2020 for 65,000. The market value on the date of transfer was 1 lakh. Shania sold these shares for the consideration of 50,000 on 31/3/2024. So she has sold the share also. There would be some capital gain implications as well, but we don't have to consider that. Why? Because that capital gain, first of all, it will be in the hands of the minor child, Shania. Although they have not mentioned that whether this Shania is a minor or not. I believe that she would be minor, considering Mr. Desai's age. Okay, let it be. So first of all, the capital gain will be arising in the hands of Shania, and if she is minor, then the income will be clubbed in the hands of parent, not in the hands of grandfather. No, it is always minor child income can be clubbed in the hands of parent, right? So in this case, nothing will be taxable in the hands of this I. So this, whatever the capital gain which would be there, capital gain or capital loss, it will not be clubbed in the hands of Mr. Desai, because Mr. Desai is the grandfather of that child, right? So in this case, we don't have to do anything. There would be some capital gain implications, but we don't have to care about it. It will be in the hands of Shania's father or Shania's mother, not in the hands of grandfather Desai. Okay, fifth point. He had taken a loan of 25 lakh for the purchase of electric vehicle. Okay, we understand that there is a section 80 EEB which says that if you have purchased a loan up to, we have a date up till 31st March 2023, so that we can give a deduction related to interest maximum 1.5 lakh. Okay, so they are talking about that loan. He has taken a loan of 25 lakh for the purchase of an electric vehicle for his personal purpose on 1/4/2022 from a scheduled bank. Okay, date is fine, because 80 EEB says that if you have purchased a vehicle up to 31st March 2023, so it is before that. We are okay with it. He paid 5 lakh as interest on such loan during the previous year 23-24. So he has paid 5 lakh as interest, but we understand the maximum limit in 80 EEB is 1.5 lakh. Sixth, he opts to be governed by the default provisions of the taxation regime under the Act. See, this guy is opting for default tax regime. So if he's opting for default tax regime, 80 EEB would not be there, because 80 EEB we can claim deduction only under normal tax regime, only under when this person would have opted out from the default tax regime. So in this case, we are also not concerned with this particular 80 EEB also. Okay, so now we have to calculate the total income of this I. So we can easily calculate the total income. See, fourth point, fifth point is not relevant for us. It's only 1, 2, 3. So 13.1 lakh minus 4.5, easily it can be set off, plus 60,000. So 13 lakh 10,000 minus 4 lakh 50,000 plus 60,000. Guys, it would be 9 lakh 20,000, 9.2 lakh. 9.2 lakh. Yes, this is the answer. 10th point says, 10th question says, in fact, which of the following statement is correct in respect of deductions available to him under chapter 6A? Okay, although he is not be getting 80 EEB deduction, but still they were asking that which of the following statement is correct. He shall not be eligible for any deduction under chapter 6A irrespective of the tax regime opted by him. No, it is not correct. Why? Because if this person would have been following a normal regime, if this person would have opted out from default tax regime, then deduction under chapter 6 is available. So this is not a correct option. No, it's not correct. He shall be eligible for deduction of 1.5 in respect of interest on loan irrespective of the tax regime. No, it is also not correct, because 1.5 lakh deduction would only be available if this person would have been following optional tax regime. In default tax regime, it is not available, and they are saying irrespective of the tax regime. No, this is also not correct. He shall be eligible for deduction of 1.5 in respect of interest on loan only if he opts out of the default tax regime. Yes, if he has opted out from the default tax regime, we would have given him 1.5 lakh deduction. So this point seems to be correct. Let us read the last point also. He shall be eligible for a deduction of 50,000. No, it is 1.5 lakh. So the answer is C over here. Got it? Okay. 11th point, what is the requirement of deduction of tax at source by game.com? So we have already calculated the winning amount is 60,000 rupees, and 30% on that amount should be deducted under section 194BA. So it would be 60,000 into 30%. It would be 18,000 rupees. So guys, B point is correct. Yes. See, 5,400 is not correct. 6,000 is not correct. There is no requirement. This is also not correct. 18,000 should be deducted by game.com, right? Okay, so this was our second case study. Okay, come to question number 12. It says, during the year 23-24, Mrs. Kalia, age 65 years, received 10.5 lakh as a family pension. She has received family pension. So we understand that this is taxable under IFOS. She had to spend 26,000 to get such income towards documentation and processing charges. She does not have any other income. Assuming she opts for the default tax regime, what shall be the total income chargeable to tax? So she has only this income, 10.5 lakh. Now we understand that this is IFOS income family pension, 10 lakh 50,000. And from this family pension, we have a deduction which is available under section 57. And now it is under both the regime. Which is the deduction under section 57. How much amount? Deduction under 57. So this was an easy question. Deduction under 57 was 1/3 of such pension, 1/3 of 10.5 lakh. It would be 3.5 lakh. Or we have a fixed amount of rupees 15,000, whichever is lower. So 15,000 would be the deduction available. So net income would be 10 lakh 35,000, guys. And we have a flat deduction over here. We have a specific deduction over here. No other deduction is available from family pension now. So examiner is confusing you by giving this 26,000 expenses. No, this will not be considered. That this is irrelevant. We can only give this deduction of 15,000 over here. So a total income would be 1035. So it would be 1035. Okay, this was pretty easy question, but still some students might get confused with this amount also. 13th, Sundaram owns 2 residential house properties in Chennai. Okay, he has 2 houses, one of which is used by him and his family. It means self-occupied. Both the houses are exactly identical and their expected rent municipal value also are the same. Okay, they are identical house. Everything is same. He let out the other house for a rent of 1,15,000 per month. He took 2 similar loans for the purpose of these houses on 1/4/2022. Okay, this person has also taken the loan on 1/4/2022. The stamp duty value of these houses is 30 lakh rupees. Okay. During the financial year 23-24, he paid 4 lakh as interest for each of the house. So he has paid 4 lakh rupees interest for each of the house, for self-occupied also, for let out also. For let out, there is no problem. There is no limit. But for self-occupied, there is a limit of 2 lakh. If this person would have been opted from default tax regime. And in case this person is following default tax regime, then even there would be no deduction available regarding interest with respect to self-occupied property. He does not have any other income or investment during the year. Okay. He has no other income other than this house property income. He did not file his return of income within the due date under section 139(1). What shall be his total income chargeable to tax? So they are asking about the total income. First of all, tell me whether this person is following optional tax regime or default tax regime. So it is not mentioned in the question. No, it is mentioned, but indirectly it is mentioned. So that is the reason I was saying that the questions were a bit tricky. So see, this line is important. He did not file his return of income within the due date under section 139(1). That is within the due date of ROI. This person has not filed the return of income. See, if you have to opt, if you would like to opt out from the default tax regime, so you have to file your return on time so that you can choose the option of opting out. And if you don't file your return within the time period, then your option lapses and automatically you will come under default tax regime. So we have to solve this question by taking default tax regime. Got it? So it was a bit tricky over here. Examiner is playing with students. So here it was a bit tricky, right? Okay, so how will we be calculating it? See, for self-occupied, I believe it would be nil. Why? Okay, house 1, house 1, house 2. Let it, this is self-occupied, this is let out. For GAV minus municipal taxes, I believe there were no municipal taxes, right? Then we get NAV, and from NAV 24A 30%, 24B interest, and we have to follow default tax regime. So for self-occupied property, we don't take GAV or municipal taxes. Simple, we can say that NAV is nil, 24A is of course nil. 24B, although this person has paid interest of 4 lakh rupees, but that would not be allowed because the person is following default tax regime. So it will not be allowed. So this income would be nil, right? And here for house there is no information regarding that fair rental value, municipal value, or standard rent. So we have to take GAV as the actual rent. So the actual rent is 1,15,000 rupees per month. So they have not mentioned that the house was vacant or let out for part of the year or so. So we will take it as a full year, 115 into 12. Guys, it would be 13,80,000. 13,80,000. And there were nothing mentioned about municipal taxes. So this will become my NAV, 1380. 30% of this amount, 4,14,000. And there is also an interest of 4 lakh rupees. There is an interest of 4 lakh. Right? 4 lakh is allowed. Yes, it's a let out property. So 4 lakh is allowed. So this is 566. So how much is the total house property income? House property 1 is nil. Second is 566. That makes 566. The answer is C, 5,66,000. I believe you got the answer. Okay. Case scenario 4 is related to GST, guys. Okay. Let me come to the descriptive part now. So we have section A, question number 1, 15 marks. It's a total income question. Quite a big question we have. So what are they asking? I always recommend that students should opt this question at last. They have to attempt this question at last. First of all, please do your question number 2, 3 or 4, any two, and then come to this particular question. But as of now, I'm just discussing, so I'm taking it up. See. Compute the total income and the tax payable for the assessment year 24-25 by Raman under default tax regime and optional tax regime as per the normal provisions of the Act. Which option is advantageous to Mr. Raman? So we have to calculate the total income also, tax payable also under both the regime, default as well as optional tax regime. Okay, and we have to comment that which particular option is most beneficial to the assessee. Good enough. So let's read the question first now. Raman is a resident individual, age 62 years, senior citizen, is engaged in the business of manufacturing and sales of spare parts of motorbikes as a proprietor. So he's an individual, he's a proprietor, and he is in the business of manufacturing. Okay. As soon as this word manufacturing comes into picture, so we should know that there would be some additional depreciation. There might be some additional depreciation also on the machine if this person is purchasing any machine in this year and that is used in their factory, then we can apply additional depreciation also, only under normal regimes, right? Not under default tax regime. Okay. He prepares his accounts on mercantile basis. If this information would not have been there, even then we would have assumed that the assessee prepares their accounts on mercantile basis. Unless and until it is mentioned that the assessee prepares their accounts on cash basis, we always assume mercantile basis. This business is carried out on the ground floor of a 2-storied commercial building owned by him, the written down value of which is 8 lakh rupees as on 1st April 2023. Okay, so he was carrying a business of manufacturing motorbike parts, and he's carrying a business on ground floor. So it's a 2-storied building. It was 2-story building. So this building has 2 floors, ground floor and the other floor, first floor. And the ground floor is used for his business. This is used for his business. Okay. And the value of this house, the opening value is 8 lakh rupees. So if we have to calculate the depreciation also, we will calculate the depreciation, but we will be restricting our depreciation only related to ground floor, right? He prepares his accounts on accrual basis. Again, they have given this information, duplicate information. The statement of profit and loss account for the previous year ended on March 2024 shows a net profit of 9.25 lakh. So they have given us the net profit as 9.25 lakh before tax. Okay, it's good that it should be before tax because PGBP is always before tax. and depreciation. Okay, so this amount is before depreciation, so we have to give the effect of depreciation as per section 32. So this 8 lakh would be useful for us. We will be calculating depreciation, and on building we understand the rate of depreciation is 10%. So on 8 lakh 10% would be 80,000, but we will be restricting our depreciation only to the portion which is being used for the business. So 40,000 would be the depreciation. So I can say that 40,000 would be the depreciation. I'm writing it over here, guys. That 40,000 would be the depreciation which we would be considering. Okay. And they are saying that it shows a net profit of 9.25 lakh after debiting and crediting the following items. So all these items which they have given to us, all these items up till here, up till the seventh point, all these items are either debited or credited to P&L account, and we got this 9.25 lakh. Okay, let me read these items one by one. So the first point says that there were traveling expenses includes 2.4 lakh being expenditure incurred on a foreign tour to Taiwan for attending a business exhibition. So if he has spent 2.4 lakh for a foreign tour that is related to business, so it's okay. This amount can be allowed, and if this would have been debited, it is fine with us. Let me read the entire one. Out of which 40,000 is incurred in Indian currency and 2 lakh is in foreign currency. Doesn't matter. In whichever currency you have incurred this expenditure, doesn't matter. So this information is not relevant. 2.4 lakh is okay with. We are okay with this 2.4. Raman has spent 10 days in Taiwan, out of which 4 days were utilized by him for attending marriage ceremony of a vendor's son. See, here he is attending a marriage ceremony. So 4 days out of 10 days, 4 days, that is 40%. The expenses which he has incurred, these were there, his personal expenses. So we can only allow 6 days expenses. So what we can do is, out of this 2.4 lakh, out of this 2,40,000, 40% would be disallowed. 40% would be disallowed. How much is 40%? 96. You got this 40% because out of 10 days, 4 days were for attending marriage function. So 96,000, guys, I have to disallow this. Disallow personal. Right, remaining is debited, that's fine with us, but 96,000 is debited, that is wrong because that's the personal expense. Okay. Second point says administrative expenses includes 9525 paid towards interest on delay in deposit of GST. So there were some administrative expenses which are debited in P&L account, and this is related to interest on delay in deposit of GST. First of all, tell me whether it is allowed or not allowed. Is allowed. It is not in the nature of contravention of law. It is not in the nature of penalty. It is a late interest, late fees, late interest, that is allowed. So this is allowed. We have nothing to do with this. We will simply give a note. We'll give the note to the examiner that this administrative expenses interest is allowable expense. So we don't have to do anything out of it. Okay. Third point. General expenses include a sum of 388,000 paid to a non-resident as fees for technical services without deduction of tax at source. So we understand if you are paying outside India or to a non-resident and you are supposed to deduct TDS, and if you have not deducted the TDS, and if you are paying outside India or to a non-resident, 100% would be disallowed. So this amount 100% would be disallowed. So again, we have a section over here 40 small a1. Otherwise, if you don't remember the section, it's perfectly fine, but you should know the provision that if it is paid to a non-resident without TDS, then 100% would be disallowed. So again, on this amount would be 3.88 lakh will be disallowed. Next is fourth point says fire insurance premium of 66,000 for the entire building remained unpaid till 31st March 2024. So there is some fire insurance premium and the assessee has debited this amount of 66,000. But this person has not yet paid. It is outstanding. It is unpaid. So can it be allowed? The answer is yes, it can be allowed. The assessee is maintaining his books of accounts on mercantile basis. So we understand that all income, all expenses can be taken on due basis, on mercantile system basis. So this is allowed. So we don't have any issue with it. This is allowed. We will simply give a note to it that yes, this is allowed. And guys, this is not part of 43B also. We understand in 43B it is rates and taxes of building. There was no insurance premium was not there in 43B, so this is allowed. So this is allowed. Do you understand all those six expenses of 43B? That is allowed only on actual payment, but fire insurance premium is not part of 43B, so you are not going to do anything out of it. So if even if it is unpaid, it's fine with us. Just simply give a note, not more than one line note. Just give a line note. You would have given a one line note. I'm also talking with the students who are going to appear in January 2025 examinations. So guys, please just mention a one line note to your answer that this is an allowable expense as the assessee is maintaining the books of accounts on mercantile basis. Fifth point. So here we will be giving a note. Here we will be giving a note. Fifth point, expenditure of rupees 75,000 was paid to a scientific research association. So this guy has paid 75,000 to a scientific research association. That is outside research expenses, outside scientific research, right? Is it in-house or it is outside? It's outside. They are donating this amount to someone else, some other scientific research association. So this is an outside research. We understand that outside research is allowed if the assessee is following normal provision. That is, they have opted out from the default tax regime. In case they are following default tax regime, then this amount is not allowed. So here we will have 75,000. We have a different treatment in regime. We have a different treatment in old regime. We have a different treatment in default regime. So if we are following, when you will be calculating your PGBP or whenever you will be calculating your total income as per default tax regime, just disallow this. Just disallow this because this is not allowed. But under normal regime, that is when the assessee has opted out, you can allow this. Okay, they have given something else also. Out of 75,000, 50,000 was utilized towards the purchase of land by research association. Again, examiner is confusing you. Again and again, examiner is confusing you. They have made this paper a bit tricky. They have said that research association has utilized 50,000 in purchasing the land. So what? We don't care about it. Whenever we are making an outside contribution, that particular person who is receiving this donation, wherever that person is using that amount, wherever that association is using that amount, we are hardly concerned with it. If this would have been in-house research, if this would have been the in-house research which is being conducted by the assessee themselves, then we know that expenditure on land is not allowed under section 35. But in case if we are paying this amount to an outside association, wherever they are using it, we are least concerned. So this information is completely irrelevant for us. Right. So some students might get trapped over here. They will say that the assessee has incurred expenditure on land. No, assessee has not incurred expenditure on land. That research association, I am least bothered wherever they are. But just I am concerned that that association should be an approved association. That is the only concern which I should have. Right. Otherwise, wherever they are spending this money, I am least bothered about it. So this information is absolutely irrelevant. So 75,000 is allowed if the assessee is following normal regime, that is opting out. But if the assessee is following default tax regime, then 75,000 is not allowed as it is an outside research. Okay. 6th point, he let out first floor of his commercial building. Okay, I was telling you that there were 2 floors. Ground floor is being used for his business. And first floor is, now they are saying that the first floor is let out. Okay. He let out the first floor of his commercial building to Aman on 1st April 2023, beginning of the year. This is let out and received rent of 35,000 per month. Okay. Municipal taxes 20,000 relating to the building were paid equally by both Raman and Aman. Rent received was credited and municipal taxes of 10,000 relating to ground floor was debited to the statement of penal account. Okay. So what they are saying is that the first floor is being let out to some tenant Aman at 35,000 per month. Okay. So first floor, I can say that this first floor is let out 35,000 into 12. would be the GAV. They have not given any information related to expected rent, fair rental value, municipal value, etc. So we can take it as a GAV and there would be house property income. Second point, they are saying that there is a municipal taxes for the entire house of 20,000. There was the municipal taxes for this house of 20,000 and half of which is paid by both. It means the assessee, our assessee, what's the name? Raman. So our assessee has paid 10,000 related to ground floor. 10,000 this he has paid for the ground floor, and this 10,000 is being debited to the penal account also. So it's fine because this ground floor is used for business purpose, and if our assessee has paid 10,000 for this ground floor, then it's a business expense. It can be allowed, no problem with that. And this first floor is being, because they are saying that for the entire building the taxes was 20,000, which is equally distributed between the two. So this person has paid 10,000, but the tenant has paid this 10,000 rupees. So this tenant has paid 10,000 rupees for the let out portion. So what we will do for this amount? See, first of all, we have not paid this amount. We have not paid this amount, and it is also not debited in our penal account. We have debited only this amount. This is a business expense. I can easily say that. But this 10,000 is the expense which is paid by the tenant while calculating your house property. While calculating your house property income, please do not give any deduction relating to this. Why? Because we take only those municipal taxes which are paid by the owner of the property, and here this 10,000 is being paid by the tenant, so we will not be giving any deduction related to this 10,000 rupees while computing your PGBP, right? Second thing, they have mentioned that the amount which he has received of house property income, how much is the amount which he has received for rent? 35,000 into 12, this is 4,20,000 this person has received. Assessee has taken it in their penal account. No, because this is house property, this is not PGBP, so we have to subtract it while computing your PGBP, and it will be going in house property computation, right? So see here they have mentioned, let me read it out once again for you. He let out the first floor of his commercial building. We understand this person, he has let out this first floor on 1st April and received rent of 35,000 per month. So there would be house property income. Municipal taxes of 20,000 relating to the building, that means the entire building was 20,000, were paid equally by both Raman and Aman. Raman is our assessee, Aman is the tenant. Okay. So 10,000 is paid. Raman has paid 10,000, which is related to the business. We are okay with it. This tenant has paid 10,000, which is for the let out portion. We will not be giving any deduction while computing the house property income. Rent receipt was credited. So this person, what our assessee has done is, he has credited 4,20,000 rupees, 35,000 into 12 in his PL account. So we understand that here we have to subtract 4,20,000. We have to subtract because this is house property income, and we will be taking it in our house property while computing the house property income. And also this assessee has a rent receipt was credited, and municipal taxes of 10,000 relating to ground floor was debited. So we are okay with this 10,000. We don't have to do anything of 10,000 because this is related to ground floor. See, they have specifically mentioned that this is related to ground floor, which is being used for business purposes. So we don't have to do anything out of it because it is correctly debited. It was not house property expense, it is a business expense. I believe that you are getting this, right? 7th point, he sold a piece of land of 44 lakh on 12th April 2023. Okay, there would be a capital gain implications also. He had acquired the land of 40 lakh on 1st January 22. 1st January 22, April 23, not more than 2 years, right? So it's a short-term capital gain. How much? 4 lakh. The gain of 4 lakh is, they have given the amount also. The gain of 4 lakh is credited to the statement of penal account. So we understand it's a simple adjustment. So what we will be doing is, we will be subtracting 4 lakh while computing PGBP because it's now a short-term capital gain, and we will be taking it in a capital gain hit. Okay, it's lengthy, but it's easy up till now. A little bit here and there was a tricky portion, but otherwise conceptually it's a very conceptual paper, guys. I'm telling you, if your concepts are strong, you'll be able to crack this paper. Okay, additional information. Raman purchased a raw material from Paul Industries, a micro enterprises. This paper is again full of amendments. So Raman, our assessee, has purchased raw material from Paul Industries, a micro enterprise, MSME, for 49,000 on March 10, 2024. Okay. However, the payment to Paul Industries were made on April 5, 2024. Okay. So we understand that we have purchased this on March 10 and the payment was made on April 5. Okay. By check. Right. No written agreement for payment existed between Paul Industries and Raman. Okay. There was no written agreement. So this point is important for us, that there was no written agreement between them. So we understand that if you are getting into a transaction with MSME, micro and small medium enterprises, then, and in case there is no agreement, so it can be allowed on due basis only if the payment is made within 15 days, right? In case there is no agreement. So here it was no written agreement and the payment was made within 15 days. No. See, 15 days would have been 25th of March. No, but the payment is being made after 15 days. So this 49,000 will not be allowed this year. This 49,000 will not be allowed on due basis. It will be allowed in the year when it is actually paid. So this 49,000 would be allowed in this year, previous year 24-25, not in our year, previous year 23-24. So 49,000 rupees will be added back. It will be disallowed under section 43B. If you remember the section, you can mention it otherwise. But you should know the provision that if you are making this payment to MSME and if there is no written agreement, it should be paid within 15 days, right? It was not made within 15 days. So in that case, we will be allowing it, but in that year in which the payment is made, not in this year. So this payment is made on this date, so it will be allowed in this year. But in our year, previous year 23-24, it will be disallowed. Got it? Okay. Another supplier, Messrs. Cull Industries, a small enterprise, again MSME, medium, micro, small enterprises, with whom also no written agreement existed for payment, was paid 134 in cash on 5th April for purchase of raw material on 31st March 2024. Okay. So we have purchased it on 31st March and again there was no written agreement and we have made the payment within 15 days. There was also no written agreement. We should make the payment within 15 days. Whether the payment was made within 15 days, the answer is yes. So 134 can be allowed. 43B will say it can be allowed in this year itself because the payment is made within 15 days. But the problem is that this amount is paid in cash. So there would be the implication of section 40A3, which says that if you are making a payment of more than 10,000 rupees in cash, it will not be allowed. So again, 1,34,000 will be disallowed, not because of 43B. We have made the payment within 15 days, but the problem is the payment was made in cash. That is the reason it will not be allowed. Right? Okay. Both Paul Industries and Cull Industries follow mercantile system of accounting. Doesn't matter. It doesn't matter to us. We are doing the assessment for Raman, so it doesn't matter whether these suppliers are following cash basis or mercantile basis. We are hardly concerned with this, so this is not relevant. Second, Raman acquired a registered trademark on July 15, 2023 for rupees 2 lakh. Okay, so we understand on trademark there's a depreciation of 25%. Raman started using this trademark for his business from January 15, 2024. Okay, purchased in this year and started using from January 15, 2024. January, February, March, less than, right? Less than 180 days, so half depreciation. So on 2 lakh, you can calculate 25% into half. Raman omitted to enter any transaction relating to this trademark in his books of accounts. Okay. Now there could be two assumptions. First of all, examiner can also take this view that this is an unexplained expenditure. If this would have been, because this is an expenditure and it is not recorded in their books of accounts. So one view you can take, both are correct. One view you can take that this is sir, we are taking this view that this is an unexplained expenditure. So in that case, 2 lakh, there would be no depreciation on this 2 lakh then, and only 2 lakh would become our income. On that, 60% tax rate would be charged, right? So if you are taking that assumption, then please do not calculate any depreciation. However, make 2 lakh as income, right? Second assumption could be that yes, this is an explained expenditure. If you are taking it as an explained expenditure, assessee by mistake they have forgot to record this in their books of accounts, and if they are explaining it to the assessing officer with proper reasoning, then yes, you can allow this expense. However, you will be allowing depreciation on this. So on 2 lakh, you will be allowing depreciation at a rate of 25%, and it's being used for less than 180 days, acquired in the same year, so half depreciation. So I can take any of the assumption. Let me take the depreciation one. Otherwise, if you, the answer would be a bit different, but both the assumptions are correct, right? So if you have taken any of the assumption, both the assumptions are correct, guys. So how much would be the depreciation? I'm taking the depreciation assumption. I will write that the assessee has explained satisfactory to the assessing officer, and this is a genuine expenses. So 2 lakh into 25% into half. So I believe it would be 25,000, right? And you remember that the assessee has not debited the depreciation also. So we have to consider this depreciation also. 2 lakh into 25%, half it would be 25,000. So this is the depreciation. Okay. Raman bought a car for personal use on 12th of April 2020 for 540. He started using this car for business purposes from 1/4/2023. As on that day, the market value of the car is 2,10,000. Assume the rate of depreciation to be 15%. Again, a very good adjustment over here. See, this person has brought his personal asset into his business. So whenever you bring your personal asset into your business, you can bring it that, and it will be taken at the same value, the same original value, not any other value, neither the written down value nor the market value. It should be taken at the same value. In case this would have been, there is an explanation to section 43(1). If this would have been building, if there is a personal building, and whenever the assessee transfers their personal building to their business building, they are converting their personal building to into a business building. In that case, we can allow deemed depreciation, but that is only and only in case of building. Remember, I have told you. However, here this is not building, this is car. So you don't have to take any market value. You don't have to take any other value. You have to take the original value. So this person has purchased a car of 5,40,000. And this person is bringing into this on this particular date. So please take this original value as the value which will be recorded in the books, and this person can claim depreciation also on this amount. So the depreciation on car is 15%. So this is being brought on this particular date entire year. It is 540 into 15. How much it would be? 81,000. Is it? I'm so sorry. Yes. I'm so sorry, guys. So, guys, if there would be any calculation error, then you have to excuse me for that. 5,40,000 into 15%. So this is 81,000 depreciation you can claim. And the assessee has not debited the depreciation, remember? Okay. Fourth point. He incurred 2,50,000 on purchase of a new machinery to be used in the production of spare parts for motorbikes on May 15, 2023. So he incurred 2.5 lakh in purchasing of a new machine that too for manufacturing spare parts. So on this 2,50,000, you will be calculating first the depreciation, normal depreciation. How much? 2,50,000. If nothing is mentioned about the machine, we understand the rate, the general rate on the machine is 15%. So it would be how much? 37,500 would be the normal rate. And also there would be additional depreciation, but this additional depreciation will be only in the case when the assessee is following normal provision, not default regime, right? So there would be additional depreciation also. How much it would be? It is used for more than 180 days, 20%. So it would be 50,000 rupees. would be the additional depreciation, but that is only when the person has opted out from the default tax regime. So this you can give under both the regime. Normal depreciation you can give under both the regime, but this depreciation only give when the person is opting out from the default tax regime. Okay. He has paid a tuition fees of 25,000 for the education of his daughter. 80C deduction would be allowed over here, but only under optional tax regime, right? Not under default tax regime. During the year, Raman has incurred 9,500 in cash for preventive health checkup, where 5,000 was for himself, 4,500 for his parents who were super senior citizen. Okay. So this 9,500 is for preventive health checkup. So we understand that we have a deduction under section 80D. However, again, it would be under optional tax regime, not under default tax regime. So 80D deduction would be available, but for preventive health checkup, maximum it would be 5,000. For both, for self, spouse, children, as well as for parents, the maximum it is 5,000. So we can only give 5,000 deduction, not 9,500. And even preventive health checkup is allowed in cash. So if it is in cash, we are okay with it. Otherwise, if this would have been health insurance premium, etc., then if this would have been paid in cash, we would have not allowed it. For preventive health checkup, we can allow 5,000 rupees. That too in cash we can allow. Donation paid to a registered political party by way of check. Okay, 20,000 rupees. Again, we'll allow it. We have two sections for political party, 80GGB, but 80GGB can only be taken by company assessee. And for non-companies, we have 80GGC. So this assessee is an individual, so we can give a deduction under section 80GGC. Even if you don't remember the section, it is okay, but you can give a deduction and it is paid by way of check. Very good. 20,000, you can give this deduction. But guys, I'm telling you that all these three deductions, 80C, 80D, 80GGC, will only be there under optional tax regime. It will not be there under default tax regime. Now, you have to compute the total income and the tax payable for the assessment year, this and this. I believe now you will be able to, you are able to reconcile your answers also, and you are able to, you are understanding this as well. Guys, don't worry, I'll be giving you the complete solution also. I'll attach a PDF and I'll giving you the complete solution of this particular question as well. Even for the entire paper, I'll give you the solution, right? Okay, guys, question number 2. Should I start? Let me read out what the examiner is demanding. Determine the residential status of Madan and his HUF and compute the gross total income of Mr. Madan for this assessment year, assuming he opted out of the default tax regime. Okay, he's following optional tax regime. So we have to determine first, we have to determine the residential status of Mr. Madan as well as his HUF. So we have to give answer, residential status of Madan, residential status of HUF, and we have to compute the GTI also of Mr. not of HUF, but just of Madan. So they are asking three things: residential status of Madan, second HUF, third is GTI of Madan. And they are saying that he has opted out from the default tax regime. Okay. Value of $1 may be taken at 70 rupees. We will take that. Okay. So the question is basically of residential status. Got it. So let's read the question first. Mr. Madan, a citizen of India. Okay. And a Karta of HUF. They were asking about the residential status of HUF also. So Madan is a citizen of India and he's also a Karta. Is employed in Messrs PCS Private Limited. So he's working with some company in India. He's drawing monthly salary of 65,500 in India on June 1, 23. So first of all, he is having, because one of the question was that we need to calculate the GTI of Madan. So one income is salary income. On June 1, 23, he purchased one residential house, okay, in Mumbai. He has not sold. Otherwise, if he would have sold that, then it would have been capital gain. Here they are saying that this person has purchased a immovable property, in fact, residential house, for rupees 18 lakh in his individual capacity, not in the capacity of HUF. It is in individual capacity of 18 lakh rupees. Okay. The purchase price is 18 lakh. The market value of the property is 32 lakh. Okay. And the value of the purpose for charging stamp duty is 23 lakh. First of all, we understand that this person here, they are talking about an immovable property. So for immovable property, we take stamp value. We don't take market value. So market value information is not relevant for us. We have to take the stamp value. Now tell me, will it be any income of Mr. Madan or not? The answer is yes. It is in the chapter of IFOS when we read about the taxability of gifts, right? You understand that we have three categories of gifts: cash gift, movable gifts, but those movable gifts should be capital assets. And third is immovable gifts, right? So in case if you are receiving any immovable gifts, so we have to take the stamp value of it. So again, we have to divide that immovable gifts into two parts, whether you are getting these gifts as free of cost without any consideration, or you are paying anything. And if you are paying less than the stamp duty value, then we can make it income, right? And please tell me whether we are paying less. The answer is yes. See, the stamp value is 23. And how much we are paying? Just 18 lakh. So 5 lakh is the difference. 5 lakh will become your income. But please understand that there is some condition also. See, first of all, it should be more than 50,000 rupees. So yes, it is more than 50,000 rupees. The difference is more than 50,000 rupees. Second condition is that there should be a difference of more than 10%. The answer is again yes, because we have to take 110% of this amount. So if we take 110% of this amount, we have to add just 1.8 lakh. It will become 19.8 lakh, guys. Even then we can see that the stamp value is higher. The difference is more than the 10% also. So we can easily say that this will become your IFOS income. How much? So the IFOS, so this person has salary income also. This person has IFOS income also. How much? 5 lakh rupees. We will calculate salary, right? Okay. On August 31, 23, during our year, he was transferred to the branch office of Messrs. PCS Private Limited in US, and he left India on 1st September 23. Okay, now he is leaving India. The overseas branch paid him a salary of $2,500. That is the reason they have given $1 is equal to 70 rupees. Okay, the overseas branch paid him a salary of $2,500 per month in US. He managed business of HUF. Okay, first of all, let me tell you this part. First of all, tell me whether he is going outside India. The answer is yes. Whether he is going just for office work, project work, or he's getting employed outside India. Sir, here his company is sending him permanently outside India, right? Now he is now working with a foreign branch. Altogether, we can say a separate entity, right? So he is not going for some official purpose, then he will come back. No, he's been permanently transferred to a foreign overseas branch, and we can also see that he's getting the salary also. So this is the case because we have to calculate the residential status of the assessee. So this is one of the case when the person is an Indian citizen and he is going outside India for employment outside. So this is the case where he is going outside India for employment outside. In that case, we don't see 60 days condition. We only see 182 days condition, right? So this is the case because he is not going just for any official work. Rather, he is altogether being shifted outside India. He's being, now he is going for employment outside India. And so Indian salary would be 65,500 into how many months? Till August. You can say till August because he's leaving on 1st September. So he's transferred on this date. So I can say April, May, June, July, and August. 1, 2, 3, 4, 5. 5 months salary is arising in India. Okay. Whether this amount would be taxable here in India or not, it is, although it is not arising in India, and I believe it's not received also in India. So it depends upon the residential status of the assessee. If this person turns out to be a ordinary resident, in this we can tax this amount also. Otherwise, we will not be taxing this amount. So let us see that the person is a resident or a non-resident. And if resident, whether ordinary or not ordinary also, we have to check. Okay. He managed business of HUF from US when he was not in India. Okay. He had also gone out of India for 99 days and 201 days in the previous year, 22, 23 and 2021 respectively. Okay. Now they are giving us the information of last 2 years also, that in this year he was outside India for 99 days and in this year he was outside India for 201 days. Good enough. he had never gone out of India prior to that. So prior to that, he was never been outside India. Got it? He visited India from January 1, 24 to January 15, 24. For 15 days, he visited India for training on a project. Okay, he just came here for a very temporary basis for training purpose. And during these 15 days, he received salary in India as per his Indian monthly salary before being transferred. Okay. So we were calculating that the 65,500 he has worked till August, that is 5 months. Again, he came back, although for a very temporary, very short period, but 15 days salary he has received over here as well. So I can say that 5 months over here and half month over here, 0.5. That means 5.5 months salary is arising in India, right? And into 65,500 because they are saying that as per the Indian monthly salary. Okay, we'll calculate it. So we have salary income as of now. We have IFRS income also. On the next page, they are saying Rajiv, one of his friends, so he has a friend named Rajiv, gifted him a sculpture in India on August 10, 2023. The market value is 45,100. Again, IFOS gift. So we understand. See, in IFOS, we see when we talk about the taxability of gift. First of all, we categorize into 3 parts. Cash gifts, that is monetary gifts. Second is movable gifts. Third is immovable gifts. Right? And here we are talking about movable gifts. And these movable gifts should be capital assets first of all. Right? They should be capital asset in the nature of capital asset. And if you are receiving it, and if the value is, again, we see that whether we are getting it without any consideration or with inadequate consideration. So here we are just getting gifts. And whether sculpture is tell me whether sculpture is a capital asset, the answer is yes. Paintings, drawing, archaeological collections, sculptures, paintings, etc. These are capital assets. However, this will not be taxable. The reason being the market value is 45. Whether we have to see stamp value for the movable assets? No, we see market value for that. For immovable property, we see stamp duty value. But for other assets, for movable assets, we see only the market value. This would not be taxable. Why? Because this amount is not more than 50,000 rupees. Okay. Now we have to determine the residential status of Madan, HUF, and for GTI of Madan. Okay. So whether that income, we understand Indian income, Indian salary income would be taxable. This 5 lakh amount will also be taxable. Whether this amount would be taxable in his hands or not depends upon his residential status. So let us calculate determine the residential status. Okay. If we talk about HUF, I believe HUF is easy to calculate. First, let us see about HUF. First of all, tell me how we determine the residential status of HUF. HUF, first of all, we see that whether this HUF is a resident or this HUF is a non-resident. And if they are resident, then we have to further divide it into whether they are ordinary or not ordinary. So tell me when this HUF becomes resident. Sir, even if the entire control or even if partial control is in India, right? Then we can say that the HUF is a resident. So we can say that the HUF, because the Karta was here, and when he went outside during the year, he was taking decisions from there. But for some part of the year, he was there here in India. So we can say that the partial control and management of this HUF is in India. So this HUF will become resident. Correct. Now, if this HUF, we understand that this HUF becomes resident because partial control is in India. Correct. Now we have to see that whether this HUF is resident ordinary or resident not ordinary, ROR or RNOR. So for that, we have to apply additional conditions. We have to apply additional conditions to see ordinary or not ordinary status. And this additional conditions is applied on the Karta of HUF. Tell me what are the 2 additional conditions. So first additional condition is that out of last 7 years, the person should be at least 730 days or more in India. And second condition is out of last 10 years preceding the previous year, last 10 years, the assessee, the Karta must be here at least for 2 years. This person should be resident. So I believe both the conditions are getting satisfied. So they were saying that last year and last to last year also, he was here in India. He was outside India for 99 days and 201 days. Okay. But before that, he had never gone outside India. So before that, if you see last 7 years, so obviously if you will count that, it will be more than 730 days. So this condition is getting satisfied, yes. And whether he in last 10 years, whether he is resident, yes, he is resident, because we see that in last 2 years, although he has been outside India for some days, but before that he was always there in India. So of course that he would be resident even he would be for more than 2 years. So both these two conditions would be satisfied. You can simply give this particular provision that what are the conditions for HUF to become ordinary resident. So everything is getting satisfied. So HUF would be resident and ordinary resident. So we can easily say that this HUF is an ordinary resident, right? Resident and ordinary resident. Resident ROR. Okay. What about Mr. Madan? Okay. So if we talk about Mr. Madan, so he's coming under the exception because he went outside. He's an Indian citizen and he went outside for employment purposes. So first of all, we have to see the basic conditions. So only one basic conditions would be applicable to this person, that he should be here in India during the previous year for 182 days or more. Right. Second condition, basic condition of 60 days and last 4 years, 365 days will not be applicable to this person. Why? Because he is coming under exceptions. So first of all, see 182 days condition, whether he is there in India or not. So if you calculate whether he is in India or not, in this previous year 23-24, April he was there, April, May, June, July, August, September. For September he was here for 1 day. April 30, May 31, June 30, July 31, August 31, September 1. And in January, he came back for a very short period, January 1 to January 15. Both the days will be counted. Okay. In January 24, he was here in 15 days. Calculate these days. 30 plus 31 plus 30 plus 62 plus 16. I believe it is 169 days. Yes. $150. Yes, it is 169 days. So you can mention that this person has been outside India for employment outside. That is the reason 60 days conditions and 365 days condition would not be available for him, would not be applicable to him. So only 182 days condition would be applicable. So he is there in India just for 169 days. So he is not satisfying the basic condition. So this person will become a non-resident. This person will become a non-resident. And even if you see, if you apply that provision also of 120 days also, so I don't think that his other than foreign sources income, that is Indian source income, is the Indian source income is more than 15 lakh rupees? I don't think so. 65,500 into 5.5, 65,500 into 5.5, 3,60,000 something, and we have to give the standard deduction also, and 5 lakh is the income. No, even that income is also not more than 15 lakh. So we don't have to apply that provision also, right? So we have to apply just 182 days. So this person is becoming non-resident, right? So if this person is becoming non-resident, of course, this US salary would not be taxable. US salary would not be taxable. Only Indian salary would be taxable. So Indian salary 5 months over here and half month over here, 5.5. 65,500 into 5.5, 360 to 50. And we have to remember to give the standard deduction also. 360 to 50 minus 50,000. So this is 3,10,250 plus 5 lakh. And he has no other income, right? That income is not taxable. Okay. So his GTI will become 8,10,250, guys. We have to calculate the GTI. So we have to determine the residential status of Madan, non-resident, residential status of HUF, ordinary resident, and the GTI of Madan is 8,10,250. Think I have not missed anything. Salary. Give me a minute, guys. Yes, yes. Okay, got it. Yes, this is the answer. Come to next question. Question number 2. It has 2 parts. Okay, answer the following. Messrs. PQR and Company, a proprietary firm. It's an individual. Proprietary firm means an individual. Of Mr. Yogesh. So Yogesh is the individual assessee. Paid an amount of 30,500 to Amit, a resident individual, age 45 years. So Yogesh has paid the amount to Amit on June 1, 2023 towards fees for professional services. Subsequently, how much amount he has paid? 30,500 on June 1. Subsequently, another payment of 60,000 rupees was due to Amit on January 30, 2024. Okay. Tax was not deducted from both the transactions. We have not deducted the tax and we have paid the professional service. We have paid the fees for professional services. So we understand that there is a tax implication under section 194J. If you are paying technical service, payment for technical services, professional services, royalty, non-competing fees, director remuneration, then you have to deduct TDS under section 194J. And for professional services, we understand the tax rate is 10%, right? Okay, so Yogesh has not deducted the TDS, okay? But this person is an individual. Is he required to deduct the TDS? So it depends upon the turnover of the preceding year. So if the turnover of the preceding year is more than, let's say this person is carrying his business. So if the turnover is more than 1 crore in the last preceding year, then TDS implications would be applicable. Okay, let's see. Amit, tax was not deducted from both the transaction. Mr. Amit, this is the person who is receiving the amount, the payee, TDS payee, not the payer, the payee. Amit has filed his return of income for assessment year 24-25 on May 2, 2024, taking into account professional fees from Messrs. PQR and Company and paid the taxes due on the income declared in the return of income. Okay. They are telling you about that provision of assessee in default. So we understand that whenever we are required to deduct TDS, and in case we have not deducted the TDS and not deposited it to the government, then we become assessee in default. However, if the person who has received this income, if that person has filed his return of income, so this person who has received this income, he has filed his return of income also. That person declares that income in such return and also pays the amount of tax also in that return, right? So in that case, we will not become assessee in default. In that case, we will not become assessee in default. But yes, we have to pay the interest. We have to pay the interest that is of 1%. This is under section 201. If you even don't remember the section, that's completely fine. But there is a tax, there is an interest of 1% per month and part of the month also 1% per month. And the date on which this return is filed, that date is deemed as a date on which the TDS is deducted and deposited. So this date is regarded as a deemed date on which TDS is deducted and deposited. So what are the tax obligation in the hands of Messrs. PQR and Company? PQR and Company is nothing but the individual Yogesh. On the assumption that accounts of the firm are audited under section 44AB of the Income Tax Act. Okay, now they are saying that the accounts were audited, and accounts were audited because the turnover was more. So we can safely assume that Yogesh was required to deduct TDS. Yogesh was required to deduct TDS. However, he has not deposited, not deducted, neither deducted nor deposited the TDS. And however, the person who has received the amount, Amit, has done his duties perfectly. He has filed the return also. He has taken into account the professional fees also in his return, and he has also paid the whatever the tax was due. He has also paid the tax. So will there be any tax obligations under in the hands of PQR? The answer is yes, there would be. First of all, we understand he was required to deduct TDS under section 40 small a, right? He was required to deduct TDS under section 40 small a because he was his accounts were required to get audited. So I can understand the turnover of the preceding year was more than 1 crore 50 lakh as the case may be. and he has not deducted TDS, right? So he was required to deduct TDS during the previous year. This section says that TDS must be deducted. TDS must be deducted during the previous year itself, and it should be deposited on or before the due date of ROI. But here the TDS was not deducted. And when it was deducted, deposited, although it was never deducted or deposited by Yogesh, but Amit has submitted his return of income on 2nd May 2024. So we understand it is a deemed date. So we can say that the tax was deducted and deposited on 2nd May 2024. Guys, tell me, this expense was related to previous year 23-24. So TDS was supposed to be deducted in this year itself and deposited on or before the due date of ROI. If both the conditions are satisfied, then we would have allowed that expense. If none of the if the condition is not satisfied, let's say any of the condition is not satisfied, let's say it was not deducted during this previous year, then we will say that 30% of that amount would be disallowed. So we will say that in this year 30% of the amount will be disallowed. However, it will be allowed in the year when it is deposited. So first of all, what are the tax implications in the hands of PQR and company? That is Yogesh. So first of all, we will say section 40 small a will be attracted. Section 40 small a will say that in previous year 23-24, you have not deducted the TDS. Therefore, 30% of such sum. How much is the sum? 30,500 plus 60,000. 30% of such sum would be disallowed. How much it will be? 60,000 plus 30,500 into 30%. It will be disallowed 27,150. However, it will be allowed in the year when the tax was paid. Although TDS was not paid by Yogesh, but the person who has received this income has fulfilled his obligation. So we always say that on 2nd of May, it will be considered as a deemed date of deposit, the TDS. So we can allow this amount, which we have disallowed in this year, we can allow it in previous year 24-25. Correct? So however, you can say, however, it will be allowed in previous year. However, it will be allowed, very, very conceptual question, guys. It will be allowed in previous year 24-25, right? This 27,500. So this is one tax obligation. Second is that this person has to pay interest also. This person has to pay interest at a rate of 1%, right? So how much would be the interest also? That is also we have to calculate. So let me calculate it here. See, on 30,500, it was on which date? June 1, 2023. And other one was on January 30. Right? We understand 194J says at the time of payment or credit, whichever is earlier, right? So here we are not making the payment, but we have credited the amount. January 30, 2024, 60,000. Okay. So how much was the tax TDS amount? TDS amount was 10%. Very, very conceptual question. I'm again saying. TDS amount was 3050 and here it would be 6,000. We have to pay 1% per month interest. 1% per month interest. Now calculate the number of months, and part of the month will also be considered as a full month. So from June 1, 2023, go till 2nd May 24. And from here also go till 2nd May 24. You have to calculate the number of months. Part of the month should be taken as a full complete month. Okay. So from June 1, 30th June, July, August, September, October, November, December, January, February, March, April, May. I believe it's 12 months, guys. June 30. June 30 is 1 month. 1st July. Yes, 11 months and some days are coming. So it will be complete 1 year. It will be 12 months, right? Guess if I have made any calculation error, then you can excuse me for that. 366, right? And here it would be from January 30. January, February 30, February, March, April, and May. 4 months, guys, right? It is May. So February 30, sorry, February is 29, February, March, April, May. Yes, 4 months. So how much it would be? 6,000 into 1% into 4. It would be 240, guys. The total tax obligation would be that he has to pay 606 as the interest under section 201. So if you don't remember the section also, still you can calculate the interest amount. So there would be two implications. First of all, 40 small a would be attracted this year. However, it will be allowed in next year. And also this year, there would be a interest obligation of 606 rupees. Okay, very, very conceptual question. Quite a lengthy question for this many marks. Quite a lengthy question for 3 marks. Okay. Fastest Limited is an Indian car manufacturer. During the financial year 23-24, it sold cars for 150 lakh to Messrs. Race LLP, a distributor. Okay. Fastest Limited is a manufacturer and they are selling the car to the distributor. Manufacturer is Fastest and they are selling the car to distributor. Distributor is Race LLP. This person is a seller. This person is a buyer. Getting it? Okay. And they sold it for 150 lakh during this year, where the selling price of each car is 7.5 lakh. Each car is 7.5 lakh. The turnover for financial year 22-23, that is last year turnover of Fastest Limited was 15 crore. So seller turnover was 15 crore last year. And Race LLP was 8 crore. His turnover was 8 crores. Okay. What shall be the TCS or TDS implications in the hands of Fastest and Race LLP? Okay, very nice. So first of all, tell me, we have one section in TCS 206C1F which says if the value of the car is more than 10 lakh rupees, then 1% TCS would be applicable. 1% TCS will be collected by the seller. Whether that provision would be applicable here, the answer is no. Why? Because that provision is only applicable if you are making a retail sale. Here the transaction is between manufacturer and distributor. So that provision cannot be applied. So that provision can only be applied when distributor is selling in retail to some customers. That provision would be applicable. So here that 206C1F would not be applicable. Also, this is less than 10 lakh rupees. Even that 10 lakh or less than 10 lakh is not relevant over here. That provision is only applicable in case you are making a retail sale of motor cars. But here it is from manufacturer to distributor. Second thing, we have, because the transaction is happening of more than 50 lakh rupees. So we have two sections. One in TDS, another one is in TCS. So in TDS, the buyer is supposed to deduct TDS. We have section 194Q. If this buyer is purchasing, the goods worth rupees more than 50 lakh rupees during the year, then we have TDS section 194Q. Provided the turnover of the buyer in the preceding year is more than 10 crore rupees. So here the turnover of the buyer is not more than 10 crore. So 194Q will not apply. And similarly, we have a section in TCS 206C1H. Even if you don't remember the section, it's fine, but you should know the provision. If the seller turnover is more than 10 crore, and here it is more than 10 crore, and if this person is selling the goods value more than rupees 50 lakh, then this person is required to deduct to collect TCS at a rate of 0.1%, 0.1% on the amount in excess of 50 lakh, on an amount in excess of 50 lakh. Got it? So here, what we have to do is, the seller, fastest manufacturer, is required to collect TCS. So TCS provisions would be applicable over here. So TCS provision would be applicable over here. Fastest Limited will be collecting TCS at a rate of 0.1% on which amount? In excess of 50 lakh. So in excess of 50 lakh, it is 150. So it is on 100 lakh. They will be collecting 0.1%. Got it? So you can easily calculate this amount. Okay, so this was question number 2. Let's come to question number 3 now. It says, particulars given below are of Mr. Radhe's income, age 47 years, posted in a private company in Delhi for the previous year 23-24. So this person is working in a private company in Delhi. Basic pay is 35,000 per month till January 31, and thereafter it is 40,000 from February 2024. So we can say that for initial 10 months till January, it is 35,000 into 10 plus 40,000 into 2. This is the basic salary. Can we calculate it right now? It is 4,30,000. So 4,30,000 is the basic salary. Yes. DNS allowance is 30% of basic salary, out of which 54% forms part of retirement benefits. That we will see in, if anywhere, if we need some, that amount, that what amount forms part of retirement benefit, that we will see later. But yes, 30% of basic is the DA, that is fully taxable. So this is 1,29,000 is the DA. We understand it would be fully taxable. 4,30,000 into 30%. Okay. Leave encashment is 23-24 in this year, 10,000 rupees. So whether leave encashment is taxable, the answer is yes. If this person is not getting retired, he is 47 years of age, nothing is mentioned about retirement, he is not getting retired. Entire year he is drawing salary. So leave encashment, if it is received during the year, so it is fully taxable. Similar, treated as bonus or something, fully taxable, right? 10,000 is fully taxable. He received salary for the month of April 24 in advance on 31st March 2024. Okay, so this person has received 1 month salary in advance, right? How much is the advance salary for April? April, it would be 40,000 rupees. And we understand this year he has received this salary. So we'll tax it. Why? Because we understand salary provision says that whenever, whichever is earlier due or receipt, whichever is earlier, you will make it tax. So 40,000 April salary, advance salary would again be taxable. So advance salary, how much it is? 40,000. Please make it taxable. Also, they are saying that also he received an arrear salary for the month of March 23 on the same day. Okay, so he has received the arrear of March 23. March 23 belongs to last year. So this is last year's salary is also has been received in this year. Whether it will be taxable, the answer is it depends. If it would have been taxable in the last year itself, then we will not going to tax it. So they have not mentioned whether it is any additional area or not. They are simply saying that it is just March salary. So we will assume that it would have been taxable in the last year itself. So here you can give an assumption. Here again, there could be two answers. First, if you are assuming that this March 23 salary was taxed in the last year itself, then please don't tax it in this year itself. In case you are making this assumption that March 23 salary was not taxed in that year, then you can bring it to tax over here. And this is March 23. If you are making it taxable, then please tax at this amount, 35,000 rupees, because in March 23, the salary was 35,000. Here you can take it 35,000 if you are taking that assumption that it was not taxed earlier. But that assumption is doesn't, although examiner will give you marks, but that assumption is not that strong because this is not any additional area. This is just March salary. So we are assuming that it would have been taxable in the last year itself. It was taxable in the last year itself on due basis. So you can say that March 23, we are assuming that it was taxable in previous year 22-23 on due basis. So we are not making it taxable. Okay. Fifth point. Her employer gave him a rent-free accommodation fully furnished in Delhi from 1/4/2019. So he was occupying a rent-free accommodation since last 4 5 years. This house is owned by the employer. Okay, this was owned by the employer. During the previous year, 1920, the perquisite value of such rent-free accommodation was valued at 39,000. Okay, in this year, when it was given, the first time it was given to us, it was 39,000 was the perquisite value. The employer also provided him with the facility of a gardener to maintain this house. The salary of the gardener paid to the employer was 1,000 per month. You can make it taxable. 1,000 into 12, please make it taxable gardener salary. Furniture and appliances provided with the house were bought by the employer and at an aggregate cost of 1,50,000 on 1/1/2020. So we understand these were owned, furniture is owned by the employer, and we take the original cost and 10% of that becomes taxable, 10% per annum. So this is again 15,000 would become taxable. Electricity and water bill of 4,000 per month for the said house were also paid by the employer. So first of all, we have rent-free accommodation also. We have rent-free accommodation also. We have gardener salary also. Gardener salary was how much? It was 1,000 per month, right? So I'm writing it 12,000. And furniture was 10% of 1.5 lakh, 15,000. Electricity water bill 4,000 into 12, 48,000. Okay, now the question is about RFA. So we understand that there was an amendment in RFA also. First of all, because this amendment was came into effect from 1st September onwards, 1st September 2023 and onwards. So we have to compute the RFA, and this premises, this accommodation is owned by the employer, and that it was in Delhi. So we understand that Delhi is a highly populated city. So we will take that maximum population. So initially it was before September, we used to take more than 25 lakh population. And after September, we have to take more than 40 lakh population. So we will assume that it is much more than that population. So we have to break it into two parts. RFA, what we will do is, first of all, we will be calculating RFA salary from April till August 23. We will be calculating RFA salary, and we will be doing how much? 15% of such RFA salary, right? Because initially it was 15% of such RFA salary, and salary starting from September 23 to March 24, you have to take 10%. There was an amendment. Now you have to take 10% of such RFA salary. So you have to calculate first April to August salary. April to August salary. And please remember, guys, just simply don't take of this value 430, because it has some because something was increased in January and February, in February also. So from April, what are the components which you would be taking in salary? First of all, please understand, you will be taking basic salary, you will be taking DNS allowance, forming part of retirement benefit only that part which forms part of retirement benefits. You will be taking leave encashment also, but leave encashment is for 10,000 for the entire year. So you can take it for 5 months, and then you can take it for 7 months. Whether arrears of salary or advance of salary would be included in RFA? No, this would not be included. Perquisites are not included over here. So perquisites, gardener, furniture, electricity would not be included. And refresher code, this is a perquisite. Wife is admitted, this is a perquisite. Okay, so you have to take, guys, while calculating your RFA salary, you have to take basic salary, DA forming part, and leave encashment. Let me calculate this for you. From April to August, that is April, May, June, July, August, 5 months. 35,000. Let me calculate it somewhere else. April to August. I'll share this PDF also with you, right? April to August. Basic salary, it would be 35,000 into 12. Why I'm doing it 12? It should be 5. 35,000 into 5, 175. DA is 30% of this amount, and out of it we have to take 54% of that, right? So I'm straight away doing it. 50 to 500 is 30% and 54%. I believe it is 54. Yes. So this is 28,350 and leave encashment also, because we take all cash emoluments except perquisites, and we will take 10,000. We are considering it for the entire year. So 10,000 divided by 12 into 5, 4166. I'm taking 4167. So this is my RFA salary. 175,000 plus 28,350. Guys, you can check the calculations. If there, in case I have made any mistake, then you can proceed accordingly. 207. Otherwise, I am calculating it carefully. Let me calculate it one more time. 35,000 into 5, 175. 30% into 54%. Okay, it is 207,517, and we have to take 15% of it. This is 127.5. So I'm taking as 128. Okay, this is 5 months per user, and from September till March 24. Basic salary would be 35,000 into 5 plus 40,000 into 2. Got it? September, October, November, December, January, 35,000. February and March, 40,000. So this would be 255. Got it? 255. 35,000 into 5 plus 80. 255. DA would be 30% into 54%. 54%, 41310. 41310, and leave encashment also. $5,833. Sum it up. $255,000. Okay, this is coming as 302,143. 302,143, and you have to take 10% of this. So this would be 30,214. 30,214. So I can say that the total amount would be this and this. Here it was 15%, here it is 10%. So 31128. It is coming as, RFA is coming as 31128 plus 30214, 61,342. Got it? This is the RFA. So I'm making it taxable. 61,342. 61,342. Okay. And now see, the examiner is again confusing you. They have given you the CII also. Guys, we don't require the CII. Why? Because if you see the statutory update also, which was released by the institute, there they have strictly mentioned that you have to take the CII would be applicable from next year. Why? They were saying that because this particular amendment came into force, in previous year 23-24. So this particular year can be taken as the very first year to calculate that amount, because we understand, because there is an amendment in RFA and it was saying that your RFA value should not be more than the inflated value. It should not be more than the indexed value of the perquisite, which was 39,000. But here you don't have to take this value, 39,000 rupees. Why? Intentionally they are confusing you. Because if you will take 39,000 as the base, if you will take 39,000 as the base, and if you will multiply it by 348 divided by 289, it is wrong. You don't have to take this. No, not at all. Because why? Because that statutory update was specifically mentioning that this particular amendment came into effect. This particular amendment came into effect from previous year 23-24. So this should be, this particular value of perquisite, you should take it either of previous year 23-24 or any later year when the house was first occupied by you. So it cannot be taken of previous year 19-20. This particular CII implication will be applicable from next year, from previous year 25, from previous year 24-25 and onwards. It will not be applicable in this year. So again, the examiner is confusing you. I believe that some of the students would have done it wrongly. They have taken this CII also, but that is completely wrong. You should not take this figure, right? Okay, we are done till here. Employer has spent 50,000 on the refresher course. You understand that this is an exempt perquisite because they are providing education facility to the employee himself. So that is not a taxable perquisite. Next, during the previous year, his wife has been admitted in a notified hospital for a treatment of her kidney disease. The hospital bills amounting to rupees 3,50,000 were paid by the employer. That is again, it would be exempt. Why? See, wife is covered under the definition of family. Second thing is that the treatment is done in the notified hospital. The treatment was done in the notified hospital. So we will assume that it is for the prescribed disease. We will assume that it is for the prescribed disease. And we can write this assumption. So that this would be exempt. It would be exempt in this case. Right? You have to compute the salary income if he has opted out of the default tax regime. So this person has opted out. So first of all, basic salary is taxable, DA is taxable, leave encashment is taxable, advance salary is taxable. We have calculated the value of RFA, gardener salary, furniture, electricity bill. Everything is exempt. You can write it and mention it as exempt. Then compute gross salary, whatever is the gross salary, give standard deduction of 50,000. Then you can come out with your salary amount. I believe that you will be able to do it. Right? There would be no other deduction. Okay, now come to the second part, B part. Raj, a resident, individual age 69 years, sold an urban agriculture land for 75 lakh to Mr. Vipul on 15th. It seems to be a capital gain question. Okay. Raj, a resident individual, 69 years, sold an urban agriculture land. So this person has sold an urban agriculture land. Urban agriculture land is a capital asset, right? If this person would have sold an rural agriculture land, that is not a capital asset. So urban agriculture land is a capital asset. And how much he has sold for? 75 lakh rupees on this date. When the stamp duty value of the agricultural land was 95 lakh. Again, there is an implication of section 50C. The stamp duty value is higher. However, the agreement to sell, okay, there is an agreement also. Agreement to sell the agricultural land was entered on July 15, 2023. So we have a prior date agreement also. And Vipul gave 4 lakh rupees as advance through IMPS. Okay, so we have this provision that we have to take the stamp value on the transfer date. But in case if there is a prior date agreement, also there's some evidence that the partial amount, even if the partial amount is paid through account pay check, banking mode, etc. So IMPS is a banking mode. So yes, then we can take the value as the date on which it was there on the agreement to sell. So it was how much? The stamp duty value on the time of agreement is 85 lakh. So we don't have to take 95, we have to take 85, right? Okay. So first of all, tell me his actual selling price is 75 and we have to compare it with the stamp value of 85 lakh. First of all, tell me we can give 10% as a grace. So if we take 110% of this amount, that would be increased by, there's a difference of 10 lakh and we can allow the difference up to 7.5 lakh, even it is more, right? So here the full value of consideration would be 85 lakh. Full value of consideration would be 85 lakh. Got it? Okay. Raj paid 1% consideration price as the commission to broker. Expenses on transfer would be 1%. 1% on what amount? 1% on the actual selling price. So it is 75 lakh. 1% of that would be 75,000 would be expenses on transfer. The land was purchased by him on May 2002. Long-term asset for rupees 10.85 lakh and it was being used for agriculture purpose by him since its purchase. So he was using it for a very long time, for even for more than 2 years it was used for agriculture purposes. First of all, it was what we need to calculate, compute the capital gain. Okay, so we can say minus index cost of acquisition, how much it was? 10.85. And we have to index it. CI of the year of transfer, this year it is 348. They would have, and 2022 it was 105. So 348 upon 105. Let me calculate this. This is coming as 35.96. 35.96. Got it? $35.96. Okay, and expense index cost, is there any improvement? No, there is no improvement. Then we have expenses on transfer also. How much? 1% of the selling price. So selling price was 75,000. It was 75,000, 0.75. Everything is in lakh. So the capital gain is coming as 85 minus 35.96 minus 0.75. 48 lakh 29,000 is the capital gain. Long-term capital gain it is coming. Okay. Raj purchased another agricultural land in the rural area on January 1, 2024 for 40 lakh. Okay. So this person has sold an urban agricultural land which is being used by him for agriculture purpose for a very long time, more than 2 years. So we understand that there is a deduction, there is an exemption which is available under section 54B, that if you are selling a agricultural land and if you are purchasing an agricultural land. So this person has purchased a rural agricultural land on January 1, 2024 for 40 lakh and this land was sold also for 45 lakh. Okay. So this person has purchased the land 40 lakh. And in fact, he has to promise that if you are purchasing a land, you have to keep it with you for next 3 years. Otherwise, if you will be selling it before 3 years, we will be withdrawing the exemption. How we would be withdrawing the exemption? By reducing it from the cost. But understand, see, examiner again is testing your concepts. Here, the assessee has purchased a rural land, rural area. First of all, whether 54B would be allowable to him? The answer is yes. He has purchased it for 40 lakh. So we understand that he can claim an exemption under section 54B. How much it would be? 40 lakh or capital gain, whichever is lower. So it is 40 lakh. So 8,29,000 would be long-term capital gain. First of all, it would be long-term capital, right? And now he is selling this rural agriculture land. And we understand that he should keep this agriculture land for next 3 years. But now he's selling it. In fact, he's selling it within 3 months itself. In January, he has purchased. In the 3rd month, he's selling it, right? In fact, it is the 2nd month he's selling it for 45 lakh. What will happen? Nothing will happen. Can we withdraw the exemption? See, the concept says that you can withdraw the exemption. How? Whenever you will be computing the capital gain, you have to reduce it from the cost. But here we will not be even computing the capital gain. Why? Because this is the rural land. So here my exemption will not be withdrawn and there would be no capital gain also on this. So he has sold it for 45 lakh. He has purchased it for 40. So will there be a capital gain of 5 lakh short term? The answer is no. It's a rural agriculture land. So there would be no capital gain. No capital gain. And also exemption will not be withdrawn. Here this person has done a very decent tax planning. Okay. Compute capital gain for assessment year 24-25. In fact, this is a tax avoidance. He has picked the loophole, and this is one of the loophole in income tax. So this person has picked the loophole. It is not tax planning, it is tax avoidance rather. So what is tax avoidance? What is tax planning? What is tax evasion? I'll tell you in finals. Okay. Compute capital gain. He's shifting out from the default tax regime. Doesn't matter. It would be same. So capital gain would be 8,29,000. Got it? Okay. Come to question number 4. It says Suraj 39 years, his wife Megha 35 years, and minor son Dev 12 years. Okay. Provide the following details for their income losses for the previous year 23-24. So we have Suraj, father, mother, and son, minor. Suraj's father. His father. Okay. Salary received as a partner from a partnership firm is 6,15,000. Is it taxable under the head salary or PGBP? PGBP. So this is PGBP income. It's salary to a partner. He is a working partner in the firm and the salary is as per the limits as per section 40 small b. Okay. So it is allowed in the hands of firm. So it will be taxable in the hands of partner under the head PGBP. We understand that there is section 28 charging section. It says that if you are a partner and you are receiving any salary, bonus, commission from your partnership firm, which is allowed in the hands of a partnership firm, then it becomes your income. This is section 28. It will become your PGBP. Okay. Income loss from a house property. Brought forward losses. So what we have to calculate? Let me find it out. Okay. They are saying compute total income of Suraj. We have to calculate the total income of Suraj, Megha, and Dev. Dev is the minor child. For assessment year 24-25, assuming Suraj has decided to pay tax under default tax regime. Okay. Whereas Megha and Dev opted out. Okay. So this guy, father, has opted default tax regime. So we have to calculate the income as per default tax regime. And for the remaining two, we have they have opted out from the default tax regime. Okay. So income from house property, in fact, it's a loss. Brought forward loss of house A, let out 96,000. So it's a loss which has been brought forward from the last year's 96,000. We understand that it can be set up only from house property income because it's a brought forward loss. And current year loss is okay. It's current year also there is a loss of house property 230. In house property we have a loss. First of all, this will again be carried forward. If it has some remaining period, then it can be carried forward. So because we understand house property losses can be carried forward for 8 years. So it would be carried forward because it cannot be set off in this year as well. Why? Because again in this year also, in current year also, we have a loss. So it would be carried forward. And what about this 230? Can it be set off from PGBP income? The question is, where can it be set off from PGBP income? The answer is no. Why? Because this person is following default tax regime. So we understand under default tax regime, house property loss cannot be set off from other head income. If this person would have been following optional tax regime, then we can set this off from other head, but maximum up to 2 lakh rupees. But here it will not be set off. Again, this would be carried forward because here you are following default tax regime. Interest received on enhanced compensation 2 lakh rupees. Okay, this is the enhanced compensation. We understand that whenever you receive interest on enhanced compensation, it becomes IFOS income in the year when you receive. In the year on your receipt basis, it becomes your income, and 50% flat deduction is available from it. So it would be taxable. Amount would be 1 lakh rupees. 50% of it would be flat deduction. Remaining 50% would be taxable as IFOS income. This is interest. It relates to transfer of a piece of land in financial year 18-19 out of this 35,000 relate to this year and the balance related to preceding previous year. Doesn't matter, because we understand, you can write it down that this enhanced compensation is taxable. Interest on enhanced compensation is taxable on receipt basis. So entire this amount would be taxable this year. However, 50% deduction would be available from this. So 50% would be available from it. So remaining 1 lakh would be taxable. So 1 lakh here and 6,15,000 here. It would be taxable. Okay. Fourth point. Gift from grandfather's younger sister by check 125. Cash gift, monetary gift. More than 50,000, yes. Is it coming from a relative? Grandfather is a relative. Grandfather, younger sister, grandfather sister is a relative? No, it is not coming in the definition of relative. So this would be again be taxable 125, more than 50,000. So this is again entire amount 125 would be taxable as IFOS. Dividend on listed equity shares of domestic companies. Yes, IFOS income dividend. This is IFOS. This is IFOS. This is IFOS. On December 1, 2023, Suraj received 75 lakh as maturity proceeds from his life insurance policy, which was taken on 1st May 2012. It is an old life policy. He paid 6 lakh as annual premium, more than 5 lakh rupees. He paid 6 lakh as annual premium, and the sum assured, they are giving, this paper is full of amendments. He paid 6 lakh as annual premium and the sum assured is 65 lakh. Okay. See, this date is important. This policy was taken on 1st May 2024. So we understand that if you have a policy on or after 1 April 2012, I always say that please remember this date. If you have a policy, you have started on or after 1st April 2012. So we can see we see only 10%. It should be, the premium should not be more than 10% of the sum assured. So here the premium is not more than 10%. The sum assured is 65 lakh and the premium is 6 lakh. So it is within 10%. So that is okay with us. Second is the amendment which came this year, which says that if your annual premium is more than 5 lakh, then such amount would be taxable. So the premium is more than 5 lakh rupees. Can I make it taxable, the amount which is received on maturity? Can I make it taxable? The answer is no, because the amendment says the amendment has came in this year. So it is related to the policy which is on or after 1/4/2023. That 5 lakh thing would not be applicable over here, because that policy should begin on or after 1/4/2023. Here the policy was started in 2012. So that 5 lakh thing will not come into picture over here. So that is irrelevant. So this amount, whatever the amount which we have received on maturity, including bonus. See, some student might get confused. Sum assured is 65 lakh. We have received 75 lakh. If you remember, the thing is that if you receive the amount on maturity, sum assured, including bonus. So 10 lakh might be the bonus. That would be exempt. That would be completely exempt. If you remember the section number was 1010D. Otherwise, no need to quote the section number. But yes, this 75 lakh rupees is completely exempt, because the amount, the premium was not more than 10%. 5 lakh limit will not be applicable over it. This policy is an old policy. Okay. That's it. It was for Mr. Suraj. So we can say PGBP income and IFOS this and this. Okay. Ms. Megha, current year loss from business. She has a loss from business. Okay. She carried on this business with the funds which Mr. Suraj gifted to her. This will be clubbed in the hands of Mr. Suraj. Why? Because they are saying that the entire business is being carried by the funds gifted by her husband. So this amount would be clubbed in the hands of it. If it's whether it is a positive income or it's a negative income, it's a loss, doesn't matter. It will be clubbed in the hands of Suraj. So what you will do is, in the hands of Suraj, they have PGBP. This can be set off. See, PGBP loss can be set off from any head except salary and of course casual income. So 8,10,000 will be set off. It will be set off from this income also, and it can be set off from IFOS also. So please set it off. So it would be, please remember that 8,15,000 loss will be set off. First from BGBP and then from, it can be set off from IFS also. Correct? Okay. So this will not be income for, it will be clubbed. Not income of, it will not be taxable in the hands of Mrs. Megha. Anyways, it's a loss, but it will not be there in the hands of Mrs. Megha. Mrs. Megha purchased a house property from her Stridhan. Okay, it was her own money, and gifted the same to her minor son Dev on 1st April 23 out of love and affection. The FMV of the house on the date of transfer is 51 lakh. Doesn't matter if he has gifted this house to Dev, so there would be no tax implication in the hands of Mrs. Megha. Okay, but if on this house property, if in this house property, if there is any rental income which is coming, then it will be taxed. It will be taxed, right? So let us see. Mr. Dev, rent received. Okay, now they are saying that there is a rent also which is received on this house property, received from Mrs. Megha, 35,000 per month. Okay. Now tell me, this is the minor child income, whether it will be clubbed in the hands of Megha or not, or it will be clubbed in the hands of parent whose income is higher or not. The answer is no. Clubbing provisions will not apply. Here, you understand the amount, the thing which is transferred is house property. You understand? We have a section 27, deemed owner. It says that whenever a property, whenever a building is transferred to spouse or minor child without consideration, right, or inadequate consideration, then the person who has transferred this property remains the deemed owner. And in that case, house property income would be taxable in the hands of that owner itself, not in the hands of transferee. So here clubbing will not apply. Clubbing will not apply. Even I would say that it will not be income. It is not income of Dev. It will be the deemed ownership concept will apply, and she would be the owner. She will remain with the owner, and there would be house property income. And whether this house property income will be clubbed in the hands of husband, no, it was purchased with her own by her own money. So how you will be computing it? 35,000 per month is the rent. So this is house property income. This would be house property income in the hands of Megha. 35,000 into 12, 4,20,000 will become GAV. Municipal taxes is not there. So minus 0 is the municipal taxes. This will become 4,20,000 will become NAV. Give 30% on this amount. $126. 2,94,000 will be the house property income in the hands of Mrs. Megha, right? And nothing would be taxable in the hands of Dev. And she is following optional tax regime. Doesn't matter, because here there is it is not a self-occupied property, it's a let out property. Even interest is not there, right? So nothing will be taxable in the hands of Dev. Very good question, but yes, a conceptual question. B point. Okay. Answer the following. Vegetable Limited files its return of income for assessment year 23-24 on 15 December 2023. Okay. For this year, they have filed the return on 15 December 2023. Okay. It's a company, right? Company is required to file their return of income up to 31st of October, right? If there is any international transaction, then 30th November, but international transaction is not there in intermediate level. It is there in final level. So for company, it is 31st of October. So 31st October was the due date, 2024 was the due date, but 2023, 31st October of assessment year 23 was the due date, but they have submitted it late. Okay, fine enough. It's a belated return. On January 2nd, 2024, the accountant of Vegetable Limited realized that he has forgotten to claim a genuine business expenditure of rupees 15 lakh. He wants to file a revised return to claim such expenditure as the assessment is not yet completed. Okay, the assessment was not completed, so this accountant was of the view that whether I can file revised return or not. Tell me, what is the concept of revised return? See, 139.5 says return can be revised. Even a belated return can be revised, no problem, but it can be revised up to 31st December of assessment year, right? or before completion of assessment, whichever is earlier, right? So assessment is not completed, okay, but 31st December of assessment year comes to 31st December 2023 is the date up to which the return could be revised, and this guy would like to revise it on 2nd of January. The answer is no. It is time barred now. It is time barred. We cannot revise the return. It is time barred, right? So in this case, in this question, although it's a small question here, it is one of the easy question in this paper. So first of all, you can mention the provision of section 139(5). If you remember the section, then you can, if you would have, even if you have not quoted the section number, it's fine. But if you have quoted the provision that the return can be revised up to 31st December of the assessment year or before completion of assessment, whichever is earlier. And here the last date was 31st December 2023. As the return was not revised up to this date, the accountant would like to revise it on 2nd of January, which is not possible because now the return is time barred, right? Okay. Okay, we have the option over here. Second question says, Mahendra, a resident individual age 45 years, earned a salary income of 2 crore rupees during financial year 23-24. Okay. He is also earned dividend from unlisted shares amounting rupees 4 lakh. Okay, so this person has salary income. This person has salary income and he has IFOS income. He wants to file his return of income for assessment year through a tax return preparer. Can he do so? Who is this? This person is a resident. This person is an individual. Can he file his return through with the help of TRP, tax return preparer? The answer is yes. So here this question is generally is of TRP. So you have to mention the provisions of TRP, that who cannot file the return through TRP. See, if there is a company SSC cannot file the return through TRP. Second, non-resident cannot file the return through TRP. And third, the person who is required to get their accounts audited. And who is required to get their accounts audited? The person who is having PGBP income. So this person is not a non-resident, he is a resident. This person is an individual, okay, not a company SSC. And he is not having any PGBP income, so doesn't matter. So yes, can he do so? The answer is yes. He can, so the answer is yes, but again, it's I believe it's a 4-mark question. So first of all, you have to explain that who are the people who cannot file their return of income through TRP. So mention those 3 points and then give your answer that in this case, the assessee is an individual not having any PGBP income. So there is no point of getting the accounts audited. He just has salary income, even though it's he's getting a good amount of salary, 2 crore rupees. Doesn't matter. He can file the return through TRP, right? Okay, last question is, it's an optional question. Rani, a Indian resident, age 34 years, did not file his return of income for assessment year 21-22, 22-23, 23-24. Okay, she has not filed the return of income of last 3 assessment years. She gives the following information regarding each of the assessment year. Okay, this year, this year, this year. She approaches you to file updated return. Okay, this question is regarding updated return, section 139(8). She approaches you to file updated return on this date. You are required to prepare a suggestion to be given to her in this respect. Your suggestion should include the financial aspect also, like payment of tax, briefly outlining the relevant provision of the Income Tax Act. Okay. You are required to prepare a suggestion to give to her in this respect. Okay, you have to suggest whether she can file updated return or not. Your suggestion would include the financial aspect also, like payment of tax. Okay, you have to calculate the amount also, the payment of tax, or if see, because we understand whenever you file your updated return, so you have to pay additional tax also. So here they are asking us to calculate the tax amount also and the additional tax amount also. Okay, let us see. So first of all, we understand updated return can be filed within 2 years from the end of relevant assessment year. So first of all, let's see. So this assessment year is ending on 31st March 2022. So if I add 2 years to that, it will become 31st of March 2024. And our SSC would like to submit the updated return on 16th of May 2024? The answer is no, it is a time barred. So here we will suggest that no, it is now time barred. We cannot file the updated return for this year. Okay, tell me about this year. If we add 2 years to it, it will become 31st of March 2025. Okay, this is within the period. And this year, of course, if I add 2 years in that, it will become 31st March 2026. So let us first find out whether we can file updated return for this year. This year, of course, we cannot file the return of income, updated return. Okay, if you see this year, tax payable on the total income of Rani is 560. This is the tax payable. And TDS deducted was 10 lakh. So this will become the case of refund. This will become the case of tax refund. And we understand you have to write it down that updated return provision says that in case if there is this is the case of refund or the refund is getting increased, then you cannot file updated return. See, updated return is more or less for the benefit of the income tax department. It is not for the benefit of the assessee. Right? Got it? I believe that you are able to recall this point. So in this case, the answer is no, because here the refund is coming up. So here the assessee would be asking refund. So income tax will not be going to give you the refund. So updated return cannot be filed because of refund. Although it is within time, there is no problem with time here. There is a problem of refund. So there would be a refund of how much? 4,40,000. Income tax will not be giving you the refund. Right? So our money has gone. This tax payable on the total income of Rani is 630. TDS deducted is 2 lakh. Okay. Here you can file the return. Interest payable under section 234 A, B, C, 90,000 calculated till 31st May. Self-assessment tax paid is 1 lakh rupees. Okay. So whether you can file your updated return, first of all, there is no issue with the time limit. So this is within our time. This is within our time. And second thing is, what is the tax liability would be? Tax liability would be, tax payable would be 630 minus TDS. How much? 2 lakh minus self-assessment tax. How much? 1 lakh. So there would be 3 lakh 30,000 would be the tax payable, right? Plus you have to pay interest also. Where should I write it? I'm writing it over here, right? So tax payable is 330. Plus we have to pay interest also. How much? They have already given 90,000 rupees interest also. Plus we have to pay late fees also. 5,000 rupees. They were asking the amount, right? So we have to pay late fees also. This is the amount which we have to pay with the updated return, and also additional tax. And also additional tax. And how much is the additional tax? It is either 25% or it is 50%. So in this case, how much it would be? Whether we are submitting it within 1 year. If we are submitting it within 1 year, then 25%. If we are submitting it after 1 year, then it would be 50%. So 1 year has not yet elapsed. We are just submitting it within next 2-3 months. So it would be 25%. And additional taxes on, it would be 25% on your tax and interest. Not on fees, but tax on interest. So 25% on 330 plus 90,000. That TRP one was easy question. You would have opted that TRP one was an easy question. So 330 plus 90 for 20 into 25%. So 1,05,000 amount. So this is the total amount which you have to pay. You have to pay the tax, you have to pay the interest, assessee has to pay the late fees also, and additional tax also, which is 25% of. Why we are taking 25%? Because we are submitting it within 1 year. So tax and interest, you have to take 25% of this amount. So this is the total amount which you have to pay. Okay. Quite tricky question. and at the same time it was very lengthy. I can say, guys, that it was a lengthy paper. Institute has not shown mercy towards students, and quite a lengthy paper, full of amendments, full of concepts. There were so many concepts in this 4 marks question that 15 marks question was again bearable, but these 4 marks question, most of the 4 marks questions were quite lengthy. So I again request you guys, if you have done it, don't worry about it. If you have done reasonably well, reasonably good also, then don't worry about it. Institute would be lenient in marking. If they will be lenient in marking, they will be giving you marks, right? So let me connect with you in my next lecture. Till then, thank you so much. And in case, guys, if in case, it's very important, in case if anybody would like to discuss with me anything regarding this paper or anything related to your attempt, if you would like to discuss with me, you are free to drop me WhatsApp on this number. Please drop a WhatsApp mentioning your name and just mention that, sir, need to discuss something. Just mention that need to discuss something. Just drop a message. I'll call you back. Right? Okay. So we'll meet in the next lecture. Till then, thank you so much. Bye and take care.